structure refers to a combination of debt, share capital, which includes equity or preference, and other sources of funds employed by a company to fund its growth and operations. Debt is borrowed money, repaid along with interest later. It can be in form of loans or bonds. Equity capital refers to money raised by selling equity shares. It is the basic share capital that every company has to issue mandatorily. Equity shareholders are owners of the company and enjoy voting rights. Preference capital refers to money raised by selling preference shares. Preference shareholders are preferred over equity shareholders when it comes to dividends and return of capital on liquidation. Let's understand debt capital and equity capital through examples. Debt capital. Company A raises $500,000 through loan from a bank at 10% per annum. Here bank becomes the creditor, and Company A, the debtor. Company A has to make regular repayments of principal plus interest to the bank over the loan term. Equity capital. Company A raises $500,000 of equity capital by giving 25% stake to an investor. The investor becomes part owner of the company and shares profits of the business. He can later sell his stake and may receive more than $500,000 basis business current valuation. Features of equity shares. Ownership. Investor who purchases equity shares becomes the owner of the company in proportion to the number of shares purchased. Nominal value. Nominal value, also called as face value, is the fixed value assigned to a share at the time of issue. It is calculated by dividing the paid-up share capital with the number of outstanding shares. Although the market value of the shares fluctuates, the nominal value remains the same. Attached rights. As equity shareholders are owners, they have right to vote, right to attend meetings and inspect the books of accounts, and right to residual claim over the assets of the company in case of liquidation. Return on shares. Every shareholder is eligible to receive dividend. However, the dividend payment is not fixed and depends on the company's decision. Transfer of shares. Equity shares are transferable. That is, ownership of equity shares can be transferred with or without consideration to other person. Irredeemable. Money raised through equity shares are not returned to the investors during the company's lifetime. Equity shareholders can redeem their capital either by selling their equity shares or when the company winds up. Linked to performance. Equities are linked to the market, and therefore its performance can fluctuate depending on factors like demand and supply, company's growth, industry performance, etc. Equity, return on investment. Equity shareholders receive a return on their investment in the form of dividend. Dividend is a share of profits and retained earnings that a company pays out to its shareholders, and can be in the form of bonus shares, or cash, or both. Payment of dividend. Rate of dividend. And the type of dividend is decided by the company's management. The amount of dividend is determined on per share basis. Therefore, if a shareholder owns 30 shares in a company and if the company pays $2 as cash dividends, then the shareholder will receive $60.